So we'll start in just a minute. We're just waiting for a couple more people to join. My name's Jack Revill, and this is Laura.
I'm Laura. Hi. Just while we wait, can we just make sure that everybody can see us, everybody can hear us? You can never be too sure with Zoom.
Exactly.
But it looks okay from our end, so I'll just assume that we heard and we seen.
Awesome.
Cool. So I think we can start. I'll just share the presentation. Okay. There we go. So thank you for everyone for being here. My name is Laura Akimova. Most of you would have spoken to me in the past. I am a marketing coordinator and investor relations manager here at Provincia, but I have been working here for just over 6 years, I think.
Yeah.
Just over 6 years. So I actually remember how the guys were buying their first property, Richard Pierce Drive. It's first out of 12 now, which is pretty cool to see. And I feel really honored to be a part of this journey of just 5 or 6 years. We've grown a fund to 12 properties, and that's just been really exciting to see. I remember that we started because a few of Jack and Carl's clients have approached them, and they just said, how about we give you the money and you buy a property for us? And that's exactly what we did. So we started basically because people asked us to start. So as a marketing person, I really like talking about the story because I think it's just a great reflection of our approach to how we do things. We are very investor-oriented fund. We are here for you. We are, created by you. So yeah, and we continue to this day, 5-6 years later, to carry and be loyal to that strategy of ours that we have, that we can describe by to create a diversified, I can't see that. To create a diversified portfolio of value-add properties in the outperforming industrial property sector to provide long-term competitive income and capital gains to shareholders. And I'll just take you through that bit by bit in a minute. So we're sticking with industrial commercial property because we find that this is an asset class that's least influenced by political, economical changes, and in today's market, it's pretty obvious that that you want to invest into something that can work through tough times,
especially on the back of COVID.
Exactly. And I think that COVID time has been a really good test to how how good your investment is. Also, we stick to value add properties. That is one of our main due diligence criteria. So we don't just focus on cash dividends that are paid to our investors. We also make sure that any money you invest will grow in value. And we've had a really steady growth of our share price. It's now sitting at 1.56 when obviously started at $1. So we've been slowly, steadily growing. And that is all thanks to our policy of value add properties. So areas with sound economics, we are proud to admit that we've had zero vacancy historically, so 100% occupancy, and that is again thanks to great work that Jack's team does at due diligence, finding properties that we know we can tenant easily, that are in great areas of high demand, and we had situations where tenants moving out and the next day the tenant is moving in. So yeah, Jack is doing
Sometimes there's been a slight overlap.
Exactly. Got in trouble for that a few times, but we'll look after investors.
It just shows the areas we're investing in are just such good demand.
Absolutely. Yeah. And that's I think that's what helping us really stay strong. And 5 to 10 million range properties, we find them they're quite easy to retenant, and we would say that in our lane we are experts. So This is a little graph of our returns. As you can see, last year has been the best. We had 18.28 overall total return. And as you can see, we do have cash return, but what we really pride ourselves in is our fair value gain. So whatever money you put in, it will grow in value. And that's, again, a reflection of great due diligence and asset management that our team does. And there is a little bit of our history, our share price history. So you can see that it's grown from 2017 from $1 to 1.56 today. And just a little bit on our on our share price. Our properties get valued every year. And what you see, the share price is a direct reflection of the value of the property. So what we do is we get an independent valuation of our properties, and then total value is divided by the amount of shares that are held, which means that 1.56 is the value of the properties that we own, and this is the only thing that affects the value of our fund. So pretty straightforward calculation, pretty easy, but that's our approach. And what we're going to talk about today is opportunities in today's industrial market, specifically sale and leasebacks. We had a webinar last week on Carbine Road. It's a case study of a property that we own. It has grown in value by just under 4 million in 3 years. So we talked about how we managed to pull that off. And I know Jack was really humble about it, but that again is just a reflection of a great job that he does with due diligence, with asset management as well. And one of the questions that we had from the investor is how likely is Carbine Road to be replicated? So we thought it's a really good, it's like a logical, thought that you'd have after seeing how well we did with Carbine. How easy is it to do it again? So obviously today's market is a bit different. It was pre-COVID when we bought it. But we wanted to talk about today, to talk about what we are seeing in the current market and how we are applying our principles, our due diligence principles, our values to what's happening in the market today. And I'll just pass it on to Jack.
Yeah, thanks, Laura. No, I really appreciate it. So today we'll go through sale and leasebacks, and we'll start by going through the deed of lease, so I can explain how the current deed of lease works, and then take it through into what we're seeing in the market right now in terms of demand for property, and then also the additional demand for sale and leasebacks. So here's the deed of lease. This is a sample of a deed of lease. So basically every property, you don't have to read the individual fine print here. It's just to give everyone an overall feel of how it works and what we do. So every property that we have in the fund is on a deed of lease. So every single tenancy, we have 22 current tenants in the fund, has a deed of lease. So the way the deed of lease works is it's a document which shows we've got the landlord, that's Provincia Property Fund, tenant, the tenant's name, and then the guarantors. There's not always a guarantor on the lease. Some leases that we have are either NZX listed tenants, and those tenants usually do not have guarantees because they're on the NZX and quite well established, or we ask for a bank guarantee. So it's quite common, and many of the leases that we have within the fund have got a bank guarantee. So a bank guarantee goes on the third schedule of the lease, which is at the rear of the lease, which basically states that the bank underwrite so many months as a facility in case of the tenant defaulting. So generally speaking, we've got 12-month bank guarantees. And what that means is it's 12 months of the net rent sitting in a facility for the bit of the bank, which has been set up by the tenant at a request of this lease, that the landlord can draw on should the tenant default. So that's the best form of guarantee that we think we can get. The slightly better form is to get a gross, so a gross bank guarantee. And that means the 12-month period also covers the outgoings. So the gross means the outgoings on top of the rent. So a couple of our leases also have a gross bank guarantee. But the way it works, and then this page here, it's all signed by the landlord and signed by the tenant and witness. So it's a fully binding document that sets out all the terms of the lease and the obligations of both parties, landlords and tenants. So you can see on this first schedule on the right here, that's the first page. So that's the description. So you have your premises description, which could be 19 Arwen, and it details exactly, I'm using 19 hours as an example, and it details exactly how much the title. So you want to reference the exact title of the property, and you want to detail exactly what floor area or square meter that the tenants occupy, especially in buildings that are split tenants. So we've got buildings such as 54 Title, which has 5 tenants within the one building. So one site, 5 individual tenancies. So that has to be very descriptive of what premises that particular tenant has. So what we do is we state it there, and then we also attach a diagram and highlight the diagram of the exact area, so there's no arguments in the future.
Especially around car parks.
Yeah, most definitely car parks. So that's the second point there, is the car parks. A lot of arguments break out over car parks, so you want to make sure we document that very clearly, especially on those shared tenancy sites. So the next point is the term. So where we try and add a lot of value is we look at leases. When we're buying the property, we're trying to buy property that might have either we can negotiate a long-term lease during the due diligence, or we're trying to buy a property that has a short-term lease that we know we can renegotiate in the future and have that upside. So such as Carbine, which is the example that Laura spoke about, that had relatively short-term leases when we bought it. So we had that opportunity. We knew we could unlock value over time in that particular building. The one we've recently just purchased, the most recent purchase beginning of this year, which was 489J Rosebank Road. So a really good location. That's really under rented. So we bought that. We know it's only got 2 years to run on the leases, but we know that those tenants are on substantially lower than market rent. So when those leases come up for renewal or expiry, we're going to get a much higher rental. And that was the strategic purchase. We couldn't renegotiate during the due diligence. The tenants were on pretty good wickets, so they weren't on board with renegotiating that lease, obviously. However, we had the ability to say, well, we know it's massively under rented, so we've got that value locked away in the fund that we can unlock in the future. So that's something we're sitting on in the next 2 years at that particular site, which is the most recent purchase in Rosebank Road. So the commencement date, that's the commencement of the current term, and then you've got your rights of renewal. So there you might have a 5-year initial term, and then you get 2 rights of renewal, 5 years each. Or that's just an example. It can vary completely. Then you've got your annual rent and car parks. So that spells out what premises rent you're paying, how much you're paying for car parks, if any, and then your total. Then you've got your monthly rent and your rent payment dates. That's a big one. And your rent review. So your rent review, you can either have your market reviews or your CPIs. With our market reviews, we like to have an item called a hard ratchet clause in, which means the rent can never fall below what it was in the immediately preceding year. So standard deed of lease terms have a market rent ratchet, which is soft, which means that say the rent at the start of the lease was 100,000, and your next market review, the rent goes up to 110. And then the one after that, it drops to say 105. The standard deed of lease means that the rent can drop at any given market review as long as it doesn't drop below what it was at the start of the lease. So if the start of the lease was 100,000, it cannot drop below 100,000, if that makes sense. But what we like to do is put an item in there called a hard ratchet. So a hard ratchet clause means the rent can never fall below what it was in the immediately preceding year. So then the rent can never fall during market review. So that's something we put in all our leases. And then we've got CPIs, which in this market is amazing. The last 5 years, it's been very low because of CPI, but now we're getting those really big uptakes. So it's all CPI rent review is quite good because it's quite give and take. In periods of high inflation, like now, we get the landlords it's beneficial to the landlords. During periods of low inflation, obviously, and low CPI, it's beneficial to the tenants. So we always have a combination of the two: market rent reviews, CPI rent reviews. Sometimes we alternate between the two as well, or you might have fixed reviews. So you might cross both these out, and you might have lots of our leases actually have fixed reviews. So say 2% or 3% every single year, and then we might chuck a market review every 5 years or every 3 years, and as well as those fixed reviews. And then we put whichever is the greater in. So that's just another way we're adding value and locking value into those leases that we try and buy. And then we've got our default interest rate. So that's basically the interest rate that we can pay, that we can on charge should a tenant default. And then the business use. So we specify exactly what the business use is. So one tenant can't change from day to day what they're doing without our consent or without changing the lease, obviously. Then this sets out the obligation. So you've got your landlord, you've got your insurance details. So you always got to set out your insurance details. We're very big on that, and making sure all the properties in the fund are well insured. And then you've got your no access period, which was brought in because of the Christchurch earthquakes. Obviously, that's only there if the building can't be accessed because of a disaster. Then that time frame, if it's deemed you can't access it for that time frame, then that's when they can cancel the lease. And then you've got your outgoing. So that's your big one, clause 18 there. That's the outgoings that the tenant pays. So you don't want to have those crossed out, because that's the outgoings that we're able to on charge to the tenant. So your rates, a lot of that's your rates, your insurance, building warrant of fitnesses, you can charge all of that to the tenant. Management fees as well, which is quite a big one. So yeah. And then second schedule, I won't go through all of them, but the second schedule of the lease. So when we're looking at the lease, your first schedule sets out your obligations and the terms. Your second schedule sets out all your definitions. So the second schedule of the deed of lease sets out all the definitions of how each clause works, and each clause you need an understanding of, especially with commercial property, because if any of them are altered, it can have big effects on the overall lease and what happens in those circumstances. So that's something we're always looking for in due diligence. And the second schedule is a very, very long schedule, as it sets out definitions and obligations of both tenants and landlords. And then we come to our sale and leaseback. So that's how the deeds work. And that's just a bit of an insight into what we're looking at and how we try and add value into the properties that we're buying. So what we're seeing in the current market is a lot of sale and leasebacks. And when I say sale and leasebacks, that's businesses or business owners that own the building that they're currently in, and they also own the business that occupies the building. And a big trend we're seeing in the market right now, especially on the back of COVID and low capital access to capital from the banks, they're being quite restrictive, especially in this market. So there's a lot of owner occupiers, we call it owner occupiers, or people that own the business, own the building as well, that are actually selling the building and doing a sale and leaseback. And what that means is they can actually sell the building, release that equity, and put the equity back into the business or to expand the business, depending on what the business plans are. And that's something you really need to assess on as why are they doing the sale and leaseback? Why are they releasing equity from the building to do what? Is the business in trouble, or is it because for expansion, or what is it for? So that's a big trend that we're seeing in the current market right now. And a lot of those owners can actually do an item. So we take this deed of lease a step further. So the deed of lease, that's generally your net leases, especially in Auckland. That's when the tenant pays you rent. They've got the obligations set out in the deed of lease, and then they've got those outgoings that they're paying. Now, in some lease cases that we're seeing, and we've got a couple in the fund, we have a lease called a triple net. So a triple net lease. Now, what that means is the tenant pays the rent, the outgoings, just like that's in the deed. But then we take it a step further, and they're actually liable to pay the capital expenditure, so the capex as well. So generally with the deed of lease, the landlord's obligations are to keep the building weathertight, do the roof if it repair, structural repairs, repairs to fences, etc. So that's an obligation of the landlord. But in certain triple net leases, that capex is actually passed on to the tenant. But that gives the tenant also an advantage, because they can operate the business. They get more flexibility on how they want to operate the business, where they want to spend their money, and they know that they can control the site without so many obligations from the landlord, or the landlord coming to site all the time, and what works the landlord needs to do and how they do the works. So it's quite an advantage for the tenant as well in that regard, because a lot of those owner occupiers, especially that are selling their buildings to do a sale and leaseback, they like that because they can keep that control still.
They have the habit of owning the building and having the control.
Yeah, exactly. So they still got that control, but it's their obligation. So it's a win-win for the landlord. It's great because they're actually maintaining the building at their cost. But the flip side is for the tenant, they get to maintain the building how they want to a degree. They can't let it, there's restrictions there that they can't let it deteriorate, etc. But the main thing is they've got control on how they do, what they do, and how they operate from the building, which is really cool to see. So as I said, we've got 3 of those triple net leases within the current fund. So we've got Hanua, which is our one out in Papakura at the moment. That's a really good building. So they had triple net lease, 10-year triple net lease. They're redesigning the site how they want. They've got a big warehouse being built in the back right corner. They're building another warehouse just to the beside that, just in the center of the site. So they're building 2 warehouses on it, which they're getting fully consented. We've seen that, we've signed it off, and they're running the site how they like, which is really good. So that's committed for 10 years. We've also got a similar situation at 7 Timothy. So they're a food operation company. So they're very restrictive on access and distribution, etc., and they're really expanding at the moment. They have been since COVID. So again, that's a triple net lease. And then the one we're currently working on, which is the one down in New Plymouth, which is this example here. This is 73 Corbett Road. So this is a really good one. So again, this is the steel company that we've mentioned that we've been doing due diligence on currently. So they occupy the building. They already own the building, and they're releasing that capital to expand their business and build another building, which is right beside this building in the future. But the main thing is they want to sell the building to free up equity so that they can buy more machinery. So they want to get a laser cutter, a wood cutter, and then start construction on a site next door as the business is really, really expanding. So we've done that due diligence here now, and they also want to invest and run this building how they have been for many years. So it's a really good site. So that's the advantage of the tenant, but the advantage to us is that's actually really good. It's viewed favorably by the valuers. So having a triple net lease it adds to the cap rate, so the capitalization rate that the valuers put on the building, ups the value for the investors and for the funds. So basically that's how we're adding value. So this one, we've managed to negotiate this triple net lease during the due diligence, which adds substantial amount of value to the building and to the fund should we buy it. So that's a really good example of what we've done. So basically the summary is that all clauses are important in the deed of lease. As I mentioned, if one is changed, it can have drastic effects later on in the lease when it comes up to that type of situation or something involving that particular clause. The other ability is able to design your own lease. So with leases, it's all about the negotiation. So we design our own leases during the due diligence to a degree, especially when we're doing sale and leasebacks, which gives us the best ability to add value. Or we have to sit on the leases that we've taken. Maybe they're the short-term leases, but we know we're going to get that upside in the future when we're able to renegotiate should the lease end.
Or should they want something from us?
Exactly. So there's an opportunity if we're to renegotiate the lease midway through the term, we can do that too. We did a lot of that over COVID, actually. So that's over COVID, we gave them rent abatements, but in exchange for those rent abatements, obviously, we did a lot of renewals. So we did early renewals to extend those leases, or we changed those leases, which added a substantial amount of value to the fund, which you can see from that value growth that we had, the record value growth that we had in the last financial year, which is very good. And the win-win for vendor, tenant, and purchaser. So that's making a deal that works for everyone, especially with those sale and leasebacks that I've just touched on, and add value before you buy. So that's key. Key to us is how can we add value before you buy, or how can we lock the value into those buildings so that we know we've got that ability to add value in the future, such as we did on Carbine. As I mentioned on Rosebank Road, for example, the current one that we bought at the beginning of this year, we're sitting on that and we know we've got that ability to substantially increase the value when we can get those rates up to market rent. To give you an example, it's about 110,000 under rented. So that's about 45% under rented. Just to give you an example of what's coming in the future for the fund. So that's going to add cash flow to all the investors massively, and it's also going to cause that share price to go up substantially. And then the good opportunities in the current economic climate. So as we touched on, there's a lot of sale and leasebacks, and those I treat as really good opportunities to negotiate. And then there's also other properties that are selling. The landlords are trying to cash out right now, so there's a slightly increased yield, as in cap rates have drops gone the other way, gone up slightly because of interest rates. So it's actually, we see it as an opportunity to buy. So you can actually buy for slightly better yields in this market. And we're definitely seeing some good opportunities. And that said, there are still really strong sales out there. One of our properties next door to Arwen, just across the road, sold for a 4.75% cap rate 2 weeks ago. So there are still really strong evidence of demand. Also in New Plymouth, one opposite the site that we've got under contract that we're trying to buy, sold for a substantially higher yield than what we're paying. Lower yield.
Already know that.
Yeah, we've got value in it. So
Exactly.
we can just see from those comparisons in the current market, which is really good. So a couple of frequently asked questions. We've got, what is a deed of lease? So this is just to summarize, from today's presentation. The deed of lease is the document that all tenants sign and landlord sign that set out the obligation for both tenant and landlord during the term of the lease, during the term of the tenure at the property, really. So that's probably the key document to all commercial property, is focusing on that lease. It's the most important part. And then how does a sale and leaseback add value? So as I touched on, having that triple net, so triple net lease, if you can do the sale and leaseback, you can negotiate either the triple net, or you can negotiate a lease. Maybe it won't be triple net, but it might be a lease that meets the landlord's requirements and also the tenant's requirements. So it's a win-win for both parties. And especially if you can have those strong conditions in, like the hard ratchet clause that I touched on for the market rent, those favorable market rent review terms and the favorable term of the lease, that's how you really add value. So the values look at that very favorably, and you've got that value add locked away with that stepped rental increase. So
it is given that if you are negotiating this deal, you have to first find out why the owner is trying to sell,
exactly.
Why they're trying to free up that capital. Is it because they're struggling, or is it because they're adding value to their business? That given that, then you can it could be a beneficial deal.
Yeah, and that's why we spend at Provincia here. We spend a lot of time doing the due diligence with that.
Yeah.
Yeah. So they're two of the frequently asked questions. Is there any? I'll stop sharing. Is there any other questions from anyone else? Should we?
You can unmute yourselves and ask a
I
question.
have a question. Thank you for the presentation. It's very informative. Do you have any interest in when you've got a property where they're expanding or building on, as you mentioned,
yep.
That it's done to the required quality? Because ultimately you're going to end up, I suppose, owning that asset, or at least owning the site that has the asset attached.
Exactly, yeah. So we've got a lot of restrictions in that sale and leaseback of their obligations. Like Hanua, that we had to approve the consent that they wanted to do. So the building consent, we got all the building consent plans, and we had to approve it prior to submitting. We're also part of the purchase price on that one was we paid in advance, or we paid a capped amount towards that in the warehouse that was being built, and it's released in segments. So we had a capped amount that we were funding as well towards it, which was capped, and the last lot isn't being released until CCC. So the code of compliance certificate based on that building consent is granted. So once we see that CCC, that last remaining and inspect the building, which we have been doing periodically throughout their build, is released. So there are restrictions like that. There's restrictions also on obligations such as the one we're doing in Corbett. There's restrictions that there's obligations of the tenant to maintain certain areas. And if they're expanding the building, they've got to make sure they've got the necessary building consents or council consents. And there's certain degrees that they need our approval for, even though it's still triple net.
So it doesn't change the owners of the building.
Yeah. So in your interest to make sure they do it properly, with properly managed and financed and that sort of thing.
Absolutely. Yeah.
Okay. Thank you.
No problem. Any other questions from anyone else?
Make sure you unmute yourselves before you start talking, because otherwise we won't hear.
I have another question, if there's just on your deed of lease under the outgoings, and I don't know if you do this, but sometimes we've experienced where you might include some of the OPEX, in your rental rate, essentially, because some of the tenants might not be, well, that might be their preference. So it might be, lease of X amount, and that includes the OPEX or aspects of it.
Like a gross lease.
Yeah.
Yeah. So that's quite common, especially down in Wellington. We see a lot of gross leases. We don't have any gross leases in the fund at the moment. So the way we've operated the fund is purely net. So that just the advantage of having it net is that if the OPEX does change, we can still on charge that to the tenant. Like you said, the disadvantage is you've always got a fixed amount with a gross. So you know exactly what you're getting in every single month, and the tenants sometimes pay a premium on top of that because they know that their net, their expenses doesn't change. So I can see the disadvantages and advantages of a gross lease, but as I said, all our ones in the current fund are net right now.
Okay. Yeah, the challenges we've experienced is when it includes some of the OPEX but not all of it. So the services, power, water might be by the tenant, but the rest isn't, and it can get a bit messy in terms of which bits you include or don't include in the
exactly
agreement. Yeah.
Yeah, absolutely. I can see it getting very messy doing it 50-50 or something.
All right, I've got another question, but I'll let other people have a turn first, if there is
Yeah.
anyone.
Yeah. Any other questions? Otherwise, it's back to you, Daniel. No.
Okay then. Do you ever look at potentially doing design build specific for tenants? So we see a lot in the market of people looking for space and looking for land, but they need something built to their requirements.
We haven't, so with the existing fund, we haven't done too many developments. I think moving forward, we'd look at it, but I don't think it's, even though it's a design build for them, we might do a restructure. So something we're doing on Arwen at the moment is not a full design build, but we're basically making the site fit for them, and that's a new lease that we're negotiating. But I think from a standard design build like greenfield or brownfield redevelopment, full scale redevelopment, I don't think the fund's there at that risk profile yet. And that would obviously be a board decision and taken to their current investors. But I think the current investment appetite is we haven't considered doing a full scale design build.
Okay, but you might do a addition or alteration to suit existing tenant to keep them more attractive, different type. Yeah, okay.
Absolutely. Yeah, we've done a lot of building refurbishments, slight alterations to buildings. Yeah, we've done a lot of that, but no full scale development.
Yeah, fair enough. Thank you very much.
No problem.
Thanks, Daniel. Any more questions from anyone in the chat?
Oh, as always, if there's any other questions anyone thinks of after this, then they can feel free to give myself or Laura a call. Absolutely. Or any of us a call, and we can have a chat.
Yeah.
So
I've just got one, please. So how do you go about organising an addition to a building? If the tenant approaches you and says, I'd like more space, how do you engineer that to happen?
Yeah, a good question. That's a really good question. So that's exactly what's happened on North Power at the moment. So North Power is our building. They're the tenant at Arwen Place, 19 Arwen Place in East Tamaki. So their lease is up for renewal September next year. So still a while to run, but they came and had a chat to us about 2 months ago, might even be 3 months ago. And it was exactly that question, is saying we need more space, but we need more space in the existing building. So it's making that building work for them. So we had to sit down with their general manager and their facilities manager at the particular site on what their needs were. So I was assessing what did they need from that site. And that basically they need more yard. That was a big one for them, storing trucks on site, and then more office space, because they've expanded. They're growing that company quite significantly, and they needed more space within their office to house more staff. So what we've got at 19 Arwen is that we've actually got a large mezzanine space upstairs. And so what we're doing there now as part of the deal is, after discussing with them, what they needed was going away and assessing how we did that. Can we restructure the office? Can we restructure the warehouse? What can we do to meet those needs? And the outcome was, let's convert the mezzanine upstairs to office. So that's something that the capital expenditure, we're just getting quotes to do now. And let's widen that yard, because we've got a lot of unsealed yard and a lot of yard area that's wasted. So we're widening the yard, sealing the yard with concrete right up to the fence line and boundary. So expanding some of the fence line, redoing that, and then also converting the upstairs mezzanine to office space. And as the cost to do that, we've assessed the cost. We've got a fixed price contract, which we're entering into. And in exchange, they're going to pay a higher rent and a brand new lease. So basically, the increase in value, which we've got the valuers assessing right now through an advisory report, will generally speaking be over two times what we're spending on the building. So that's your rule number one, because then we're getting double what we're spending, which is going to add value to the fund. And then we're also getting quite a large return based on that money that we're spending as well, in additional rent that the tenant's willing to pay. So that's how we engineer those types of deals.
Okay, so in terms of plans and things, do you work together with the tenant and an architect to organise the plan for that?
Yep, absolutely. So currently we're working with Hume Architects on this. They're based down in Auckland. We've got a really good relationship with them, and we're working with North Power on that particular site.
Okay, so just a bit of a personal question here. I've got a building that the tenant wants a canopy or some extra space added on. So how would I go about doing that?
Yeah, so that's a really good one. I'd have a discussion with the tenant. Like, it's such a good opportunity because they have a discussion with the tenant about what, if you do that work, what's in it for I guess, in your point of view, how does it work for you? So would you want a new lease? That's number one. Would you want a new initial term? So they might have 2 years to run or 3 years to run on the existing lease. You might want to bump that up to, say, a 6-year lease, because little things like that can help and add value and security, because you're going to spend a significant cost doing that. And then number two is, okay, what's the cost? So what I'd look at doing is, what is the cost? Or you might contribute some of the cost. So you might say, well, why does the tenant do it? But you'll spend X, and based on spending X, you need a return of specify the number. So it's having that open discussion with the tenant to make it work for both parties. And that's how I'd do it. So that's a really good opportunity to strengthen that lease for you, get a longer term lease which adds value, and also increase that cash flow based on what you're spending to canopy in, and also anything else the tenant might want. They might want some refurbishment, maybe to the bathroom or the kitchen area or anything else on the particular building.
Okay, perfect. Thank you.
No problem.
Corianne. Any more questions?
And if anyone wants to speak to us outside of it, we're more than happy to take phone calls, as I stated before as well. So
yeah, absolutely.
Yeah, really
Just
appreciate
send
it.
us an email.
All right. Oh, well, if there's no more questions, thank you, everyone.
Thanks so much for coming in, for being with us here.
Brilliant. Thank you.
Thank you.
Thank you. Cheers.